If you had invested $1,000 in the NASDAQ 100 in January of 1998, it would have turned into $5,000 within just 2 years. To put this in perspective, it took the NASDAQ a whole decade for it to deliver these returns between 1987 and 1998. We're on the edge of seeing history repeat itself today. Investors that are exposed to the right parts of the market will be able to generate 1999 style returns over the course of the next year, but it won't be happening on the NASDAQ 100 like it did back then. One of the key characteristics of the macroeconomic backdrop in 1999 was that inflation was dropping like a stone. The headline inflation rate in the US went from being roughly 3.2% in 1996 down to just 1.5% by 1999. Part of the reason that inflation was cooling down so much was because oil prices were moving down. Between 1997 and 1999, oil prices dropped by 60%. This put tremendous downwards pressure on overall inflation, and this gave the Federal Reserve room to keep their interest rate at very stable levels throughout the late 1990s, and even provided room for them to cut interest rates, which they did in 1998. Stable monetary policy, stable interest rates means stable and predictable conditions for investors. And this environment provided the perfect conditions for investors to speculate on US stocks, which fueled the melt-up in the technology sector. Now, today the situation in regards to inflation is not very different. The headline inflation rate in the US has been gradually moving lower over the last few years and has not yet been showing signs of turning back up. And just like it was in 1998, this cool down in inflation has been driven by lower oil prices. Oil prices have dropped by almost 50% from their peak in 2022, and they've stayed low despite the geopolitical risk from the Middle East. And similar to the late 1990s, this has allowed the Federal Reserve to adopt a very stable monetary policy, keeping their interest rate level and even lowering it in 2024, with potentially more rate cuts to come in 2025, providing even looser conditions for financial markets. So from a macroeconomic perspective, we have clear parallels between 1998 and today. But if we zoom in closer on the S&P 500 index today and we overlay the price action from 1998, we see it's not just the macro that's similar. The price action is also strikingly resemblant. In both of these episodes, the market crashed violently following a specific event that triggered concerns around economic growth and then proceeded to recover violently. In 1998, it was the Asian financial crisis and the Russian debt default that led to the collapse of a massive hedge fund in the US called LTCM. People thought it was going to crash the economy, but it never did so, and the markets recovered. In 2025, people have been concerned about the trade war triggering an economic paralysis, but that has also not happened as the economy continues to grow in 2025. Now, this section right here, right after the 1998 recovery, corresponds to the exact moment where the NASDAQ 100, the technology sector, began melting up in a spectacular manner. If we're at the same point in the cycle as we were in back in 1998, it could mean that we're on the edge of seeing certain parts of the market begin to melt up. Now, in 1999, the melt-up in technology stocks was fueled by the internet boom. Investors were convinced that the internet was going to change the world, which caused massive amounts of capital to flow into the technology sector during these favorable macroeconomic conditions. Today, there is a clear parallel to the internet, and that is artificial intelligence. And we also have evidence that AI is actually being adopted just like the internet was back then. The percentage of firms that are reporting that they use AI tools in their operations is going up from quite low levels at 4 or 5% of businesses in early 2024 to now accelerating higher, reaching almost 10% of businesses using AI. This chart represents a very real and rapid trend in adoption. This AI narrative has already translated into exceptional performance for the semiconductor sector that is up 200% since ChatGPT was released in 2022. This includes stocks like Nvidia, AMD, TSMC that produce the chips that are required to power AI. Over the same time period, the broader S&P 500 has only risen by about 70%. But if we're heading into a 1999 style melt-up, the returns that semiconductor stocks have produced so far will look like nothing compared to what's coming next. If we look at the performance of the technology sector in the 3 years leading up to 1998 against the S&P 500, we can argue it looks similar. Tech stocks returned approximately 200%, while the S&P 500 index returned 80%. Now, in the year that followed, the Nasdaq 100 posted an additional 200% return, while the rest of the stock market rose by 30%. Now, we can look at whether this is a plausible scenario for semiconductor stocks over the next year. One of the key driving forces behind tech stocks in 1999 was the fact that the valuations of the sector went from a PE ratio of 30 in 1998 all the way to 50 by the end of the dot-com bubble. The PE ratio is the price that investors are paying for the underlying earnings of the companies within the tech sector. As investors got more and more euphoric, they paid a larger and larger premium to be owners of technology stocks. Today, if we look at the valuations of the semiconductor sector, they currently stand at a PE ratio of 30. This is exactly the same valuation that technology stocks had back in 1998. So theoretically, that means semiconductors could have plenty of room to get more expensive over the coming months. But in order for this to happen, we need to see the semiconductor sector growing quickly, just like internet companies were growing quickly in the late 1990s. The technology sector's earnings between 1996 and 2000 grew from $10 to $20 per share. That equals to roughly a 20% annual growth rate for the tech sector during the internet boom. If we look at the earnings of the semiconductor sector today, we see that they jumped from $100 in mid-2023 to $230 in mid-2025. This equates to roughly a 50% annual growth rate. So the underlying strength of the semiconductor sector today is actually superior to the performance of technology stocks during the internet boom. Let's say that semiconductor stocks can maintain this 50% annual growth rate over the next year, and let's say that this makes investors more euphoric on the semiconductor sector, leading PE ratios to jump from 30 to 40 in 12 months' time. That would yield approximately a return of 80% within 12 months, possibly taking SMH, the semiconductor ETF, to over $500 as a result. This is a scenario that we think is actually plausible today. We currently have multiple semiconductor stocks on our watch list at Bravos Research that we think can perform incredibly well in this kind of environment. Although we've been of the opinion that the market could cool down for a few weeks, we're looking to load up on some of these trades to take advantage of a potential euphoric move up in semiconductor stocks. If you want to follow our entire trading strategy step by step, get access to all of our buy and sell alerts, make sure you subscribe to our membership. You can see all of our closed trades for 2025 and 2024 by clicking on the link in the description below. Thank you for watching.